Good morning. Welcome to IG's early morning call. It's Tuesday, the 10th of October. Let's take a look at the headlines as we continue to see the markets reverberate after the Middle Eastern conflict got underway again over the weekend. Oil settling after rallying more than 4% yesterday. We've also got gold holding on to the recent gains that we've seen as people seek some sort of safety. But at the same time, we've got the return of the US Treasury markets today, and we've seen yields drop. We've got the dollar softening. Investors looking for a shift in the mood in some of the recent Federal Reserve comments that we saw yesterday, and this has given some sort of a steer lower for the US dollar. But as I said, at the same time, we've got money going back into the bond market, steering yields low. We've got a yield down from Friday's 4.8% US 10-year Treasury, now down to 4.65%. So that's a fairly steep move after yesterday's Columbus Day holiday had no trade in the US Treasury markets at all. UK retail sale is the area of the market I want to take a look at specifically here in the UK, because that causes another headline. We've got a drop in the sales growth here in the UK in the month of September, according to the British Retail Consortium, as you see more money going into fuel over some of the discretionaries. Take a look at volatility and this return of the bond markets yesterday and a general sort of settling after the weekend's turmoil geopolitically. You can see yesterday we saw a fairly hefty candle on the way down, and we're holding on to that at 1809 at the moment. So volatility on the way down. And it's fairly safe to say at the moment that we're looking for gains across the European markets. In fact, more so in the London markets than anything else. London has benefited from this rise in the price of oil, which we'll take a look at in just a couple of minutes' time. But I think behind that, we've got this relationship now come back into focus between what's happening with Saudi Arabia, the world's largest, or the swing producer in the oil markets, the world's largest producer, and the relationship with other regions around the world, and of course the difficulties that Saudi has with Iran. And of course, what's been happening over the weekend has brought this all back into sharp focus. We've got oil on the way up, London markets benefiting from that. Also, we've got a rise in base metals as well, which has some of the mineral companies doing better than expected. So that again is another reason I think why we're buying back into the London markets. Germany, we had earlier gains this morning. These are 24-hour markets. You can see the candle shape today. We've got a wick on the upside. We're well off today's highs at 15,244, but I can still say that we are expecting gains on the German DAX, and the same for the French markets as well. Not quite as high as we were at the back end of last week, but you can see that we've got gains for a third day. 7,075.6 is where we're trading there at the moment, looking for a gain across many of those European markets in the session in today's trade. Let's take a look at what's been happening overnight in the Asia-Pacific markets. We've seen people buying back into the bond markets as we see money going there. We've got money going into the equity markets as well. Nikkei 225 up 2.5%. Hang Seng Stock Index and the S&P ASX 200 both up over 1.3%. And as I said, the US markets, the bond markets were out yesterday, but the US equity markets were trading. And we saw some Federal Reserve comments, which I'll take a look at in just a few moments' time. But broadly speaking, it was a day of gains across the US equity markets. The Dow, the S&P 500, the NASDAQ, all up, grouped around that 0.5% gain sort of region for all the major markets. I want to show you the shape of the candle moves that we saw yesterday. This is 24-hour markets with a move further on up into the session yesterday. 24-hour markets opening at 33,588 for the Dow. The tech-heavy NASDAQ, yesterday's trade, we saw the highest trade there since the 20th of September, and not much move on from the close yesterday at 15,062. So oil prices climbing in the aftermath of the Hamas attacks on Israel, both WTI and Brent benefiting in yesterday's session as we saw the week get underway. So far, the oil price movement has been driven by increased geopolitical risk rather than any tangible impact on supply. But this has been one of the big messages we've been delivering over the last few weeks, that we've got supply restrictions moving in, which has given us a little bit of a rise. But this attack by Hamas will likely undermine efforts to normalize relations between Israel and Saudi Arabia. IGTV caught up yesterday with Bill Blaine, global strategist at Shard Capital, who says that Saudi Arabia is key here.
The key thing markets should be watching is the price of oil, and that means watching what Saudi Arabia does. Saudi has a choice here. Their key enemy, of course, is Iran. But do they continue to support Russia and Russia's efforts to push up oil prices? Or does Saudi take the view that they need to bring oil prices down to avoid this conflict spreading? The problem for Saudi is they are perceived to be the leader of the Arab world. if they don't react in the right way to the obvious indignation that Arab countries are going to feel when they start seeing pictures of Gaza being razed to the ground this week, then Saudi is the loser. But can they afford to go ahead together with Iran, who seems to be behind this attack? That's going to be the interesting moment.
Bill Blaine from Shard Capital talking yesterday. This was the gap up that we saw yesterday from Friday's trade up to the start of yesterday's session. And we ended up on the markets with a fairly wide range of trade yesterday, with a very long sort of candle reach, if you like, in terms of the wicks. But in fact, where we entered and where we left the day, not too far away. Today, you've got a little bit of money taken off the table, broadly speaking, holding on to much of the gains that we saw in yesterday's sessions. I want to show you what's happening with US crude as well. You can see bouncing off the 76.4% that we saw at the back end of last week. And then this push up on concerns about the fact that the markets obviously could well be tighter supplies because of what's happening. But of course, as humanity continues to monitor what's going on, the tragedies unveiling with families and people completely lost with these attacks that we've seen over the weekend. I think one of the other areas of the market's worth looking at, I'll take a look at the dollar in just a minute, but one of the other things we've seen moving, and I talk about the dollar in the context of this because of the dollar relationship with gold. I want to show you the chart of gold because we saw a big jump in yesterday's session as well. But interesting enough, we got stopped out at the point of support that we had when we saw the unraveling of this symmetrical triangle here, which I was talking about last week, and the price target that we had that we saw then end up being completed back on the 20th of September. But for some reason, this market seems to have stopped out with gold hitting a ceiling at 1863. Down today, but broadly speaking, holding on to much of what we saw in yesterday's session. And this is all to do with the dollar. I want to show you the dollar basket because I think this is all to do with this story as well. In yesterday's session, we saw it disappear below the underside of this rising line of support. It settled below 106. We're currently trading 105.82. Interestingly, we're finding support at the highs that we saw back on the 8th of March at 105.51. Remember, we were talking about this all the way back in early spring when we were talking about the top of the market there. But that candle there back on the 25th of September, as we saw an emphatic sort of defense of this idea that the Fed's going to stay high on rates for longer. It may not raise rates that much more, but certainly now people pricing another 25 basis points come the November meeting. But then since then, we've seen still a bit of a pullback. Now, as of yesterday's close, disappearing below the underside of this rising channel here, two Fed officials turned around the mood in US rate outlook. The Dallas Fed President Lorie Logan said yesterday, if long-term interest rates remain elevated because of higher term premiums, there may be less need to raise the Fed funds rate, contrasting with the previously hawkish rhetoric. The Fed Vice Chair Philip Jefferson said the central bank would need to proceed carefully given the recent rise in yields. A handful of other officials, including Fed Governor Christopher Waller, also scheduled to speak on Friday. I want to show you the trade out of this, the euro-dollar trade. We've not seen much move, to be frank with you, since Friday's close of the market. So we saw the euro trade higher against the US dollar, despite that stronger than expected jobs report on Friday, currently trading at 105.56. So that's where we're standing there at the moment. But it's an interesting point to make that if interest rates do respond to this move up that we've seen in the dollar, that then, as we saw that move, that quote yesterday from Lorie Logan, suggesting that the high level of the dollar does much of the heavy lifting of the monetary policy. So interest rates won't actually have to move that much further up. So we're still expecting 25 basis points the next meeting come November from the Federal Reserve. Now, the high cost of living continues to bear down on households across the UK in the month of September, according to the latest BRC survey on UK retail sales. The British Retail Consortium's like-for-like sales measure, which adjusts for changes in store space, slowed to show a growth of 2.8% from 4.3% in August. Now, the recent increase in the price of petrol and diesel in housing costs has meant that the consumers held off on much of their non-essential spending. Expensive items like furniture and electrical items performing particularly poorly, as one might expect. Separate data from Barclays showed the pace of annual growth in the amount of money spent on credit and debit cards increased to 4.2% in September from August's 2.8% rise. This acceleration was largely due to higher motor fuel prices. The Rugby World Cup also playing its part, spending in bars rising last month. I want to show you what's happening with sterling against the US dollar. Broadly speaking, holding on to the recent gains we've seen in the face of the recent dollar weakness. I want to show you what's been happening on 10-minute candles, just to show you when we saw the break of this news earlier on today. That was overnight, where we saw the release of that data. You can see sterling on the way down since that overnight release. These are 10-minute candles, and we're currently trading at 122.21. In Australia, we've seen some interesting statistics out overnight coming through on confidence, both in the consumer sector and also on business sentiment. Westpac consumer sentiment rebounding 2.9% in October from the previous month to 82. This means that pessimists still outnumber optimists. The index has been below the neutral 100 mark since March 2022. The longest streak since the early 1990s recession. Of course, all this comes as interest rates were held steady for a fourth straight month. And the NAB business confidence remaining at 1 for the third straight month, suggesting firms are evenly divided in terms of the business outlook. Show you briefly what's happening with the Aussie against the US dollar. But again, this is really all about what's happening with the US currency rather than anything else. This rise that we've seen recently in the Aussie in the expense of the weaker US dollar, broadly speaking, held on to at 64.02. Let's take a look at a couple of stocks worth watching today. I want to begin, first of all, here in the UK. We've seen a release from the newspaper publisher Reach, formerly Trinity Mirror. The numbers out for the third quarter. Group revenue down by 7.8%. Digital revenue falling by a whopping 13.7%. Print revenue down 5.8%. Now, you think to yourself that these are not looking particularly good. Now, this has got nothing to do with profitability. This has got nothing to do with the overall profit and loss accounts. It is just revenues. Reasons including depressed open market yields and well-publicized declining digital referral volumes, in particular from Facebook's deprioritization, of news. As a result, over the 9-month period, year-on-year page reviews down 21%. Interestingly, for me, data-driven revenue, which was higher value and more targeted, continues to be robust and now makes up a larger part of digital revenues at 42%. In other words, they're selling people's habits, they're selling people's intentions and the sort of journeys, if you like, through the digital stream that Reach has. And I think the company, as a result of this, says it remains confident of meeting profit expectations for the full year. I don't know where this is going to go. Yesterday, we saw a drop of 1.7% on the stock, closing out at levels not seen since the 21st of September. Meanwhile, in the US, before the US trade gets underway, we got numbers coming out from PepsiCo. Analysts say PepsiCo is expected to register bottom and top line growth when it reports third quarter 2023 numbers today before the opening bell. The Zacks consensus estimate for third quarter revenue is for a 6.5% gain year on year to $23.4 billion. Earnings per share, watch out for $2.17, suggesting a 10% growth from last year. PepsiCo benefits from a diversified portfolio away from its flagship Pepsi drink. It's also been hard in modernizing its supply chain. It's improved its digital operations and distribution system, so has an advantage over others in the sector, most notably Coca-Cola, which is by far and away the bigger company. But the PepsiCo is, with its diversification, doing well. But look at the share price chart recently on the way down. Shares of PepsiCo and also Coca-Cola have been slammed after Walmart's US chief executive last week said the new class of weight loss drugs like Ozempic and Wegovy were causing customers to buy fewer groceries and cut back on those that are high in calories, such as soft drinks. And that statement coming, when was that, Thursday last week, and you can see that big pullback we saw in PepsiCo. Was trading yesterday. The stock closed out at 161.31. It's not an all-session stock, but certainly worth watching at the start of today's trade after reporting numbers out later on. Now, let's move on to just one other area of the market I want to follow up on, just retouching on what's going on with the markets for the big areas of base metals. The benchmark, copper, on the way up yesterday, the last couple of days actually, but today got a little bit of money taken off the table, but it remains above 8,000, 8,029 for those watching that psychologically important level. That's it from me. Back at 10:30 with Charting the Markets. Watch out for reach at the start of today's trade. And we'll be following up on PepsiCo as well at 1:30 today when Angeline Ong takes over with a look at Beat the Street, watching for some of the stock movements in the US later on today.